Welcome to this deep dive. Today, we are putting Varun Beverages Ltd, VBL, under the microscope.
Yeah, VBL, one of the world's largest PepsiCo franchisees.
Exactly. And their Q3 and 9-month results, they show this perfect duality, really. How does a huge beverage player handle something like, well, terrible monsoon weather?
A really catastrophic external variable.
Right, while simultaneously setting up the blueprint for its entire global future. It's fascinating.
So that's absolutely the core tension we need to unpack. We've dug through the earnings call transcripts, the financials, the presentations.
All the good stuff.
All of it. And while VBL's immediate performance, it was definitely shaped by that really challenging heavy rainfall across India.
No doubt about that.
The real story here, I think, is the aggressive, long-term strategic stuff. Global expansion, product diversification, big moves.
Exactly. We're looking for so what behind the numbers. So our mission today, let's focus on 3 things.
Okay.
First, how did VBL financially engineer such a major profit jump, especially when revenue growth was so slow because of the weather?
Right, that PAT number really jumps out.
It does. Second, we need to get clear on this subtle accounting shift. It's related to operational efficiency, bit jargon heavy, could easily confuse someone.
Yeah, the backward integration impact. We need to break that down, simply.
And third, we absolutely have to dive into the company's very bold diversification. I mean, new territories and this really intriguing entry into the alcoholic beverage market in Africa.
That Carlsberg deal, yes. Lots to cover.
Okay, let's start with the immediate impact, the monsoon effect. Q3 CY 2025 consolidated sales volume grew, but, well, barely, 2.4%, hitting 273.8 million cases.
Yeah, and the story is completely split by geography.
How so?
Well, management was very direct. India volumes, largely flat, directly because of that persistent heavy rain, especially during their peak selling season.
Oof, terrible timing.
Exactly. But that drag, it was significantly offset by the international operations. They grew robustly, 9.0%.
Wow, 9%. Where did that come from mainly?
Led by a really powerful performance in South Africa. They seem to be firing on all cylinders there.
Okay, so looking at the financials for Q3 then, net revenue from operations. Only up a modest 1.9% year-on-year. That reflects the flat India volume, I guess.
It does, and we also saw a slight dip in net realization per case, down just a bit, to ours 178.84.
Why the dip in realization?
That was mostly about product mix. They sold a higher proportion of packaged drinking water, particularly internationally. Water naturally has a lower price point than, say, CSDs, carbonated soft drinks.
Right. Makes sense. What was the overall mix then?
Despite that shift, CSD still dominates. It was 74% of total volume. Packaged drinking water was 22%, and the non-carbonated beverages, NCBs, were about 4%.
But here's the kicker, the real shocker for anyone just glancing at the numbers. Only 1.9% revenue growth, flat volumes in India, their biggest market.
Yeah.
Yet profit after tax pat soared, up an incredible 18.5%.
Yeah.
How do you even manage that level of profit growth without the volume really moving?
It's a textbook example, really, of efficient financial engineering kind of overriding the top-line sales volume. 2 main drivers here. First, lower finance costs. Remember, they repaid a chunk of debt using proceeds from that qualified institutional placement, the QIP.
Ah, yes. I remember that.
Well, that made their borrowing costs in India practically negligible this quarter. Huge saving.
Okay, so that's one big piece. What's the second?
The second was a significant jump in other income. This included favorable currency movements across their international subsidiaries and also interest earned on their cash deposits back in India. So basically, they cleaned up the balance sheet before, and you're seeing the direct benefit flow through to the bottom line now. Now, shifting gears a bit to how they actually make the product, we saw strong operational improvements on that front. Gross margins actually increased, up 119 basis points to 56.7%.
Okay, that's good. Higher gross margins.
Very good. Management credits this to the benefits they're getting from their ongoing backward integration initiatives.
Wait, hold on, though. If gross margins are improving, which is great news, right? Why did EBITDA stay flat, actually down slightly, 0.3%? And the EBITDA margin dipped to 23.4%. That sounds contradictory. What are we missing?
Yeah, that's the crucial clarification we mentioned. And it is purely an accounting effect. It's driven entirely by that backward integration push.
Okay, explain that a bit more. Backward integration means?
Think of it this way. VBL is increasingly choosing to, let's say, own the farm rather than just buying the produce.
Okay. Owning the farm. I like that analogy. Makes sense.
Exactly. So when VBL moves upstream, integrates backward, meaning they start producing more raw materials or inputs in-house, the expense doesn't just disappear, it just changes categories on the income statement.
Ah, okay.
So a portion of what used to be booked as raw material purchases, which hits the cost of goods sold and therefore impacts gross margin, is now shifting down the P&L. It becomes internal operating expenses, things like employee costs, power, fuel, other manufacturing overheads.
Got it. So they spend less buying from outside suppliers, but more running their own newly integrated factory or process. The cost moves from the top part of the income statement down towards the middle.
Precisely. And management was very clear. They stressed that the underlying business economics, still fundamentally strong, this accounting shuffle just temporarily moderates that reported EBITDA margin compared to last year when they were buying more externally.
Okay, that clarifies it. Thanks. So it's not a sign of weakening operations, just a change in where costs are recorded.
Exactly. And this operational focus, you can also see it in their capital expenditure. Depreciation costs rose pretty significantly, 19.9%.
Why so high?
It's a direct result of commissioning new capacity. They brought new plants online in India and the DRC, and also a new can line in South Africa. They are clearly building capacity for the future growth they expect.
All right, let's swing back to the Indian market then. The earnings call transcripts focus really heavily on competition, specifically this aggressive euro price point that some key competitors have adopted, especially for smaller packs. That sounds like serious heat.
Oh, it is. Serious competitive pressure.
But VBL seems to be taking the long view here.
How so? What's their strategic take?
Their view seems to be that this competition is actually healthy in a way. They argue it's effectively growing the market.
Growing the market. How?
By driving initial adoption, trial, particularly in rural and semi-rural areas. These are places with historically very low per capita consumption of beverages.
Right. Huge untapped potential there.
Exactly. They believe India's overall beverage market potential is just enormous. They're talking double to triple in the next 5 to 10 years. And aggressive pricing, like this 10-point, it just accelerates penetration into those newer markets. Okay, I get the long-term logic. But isn't it risky to just, well, rely on long-term potential when competitors are aggressively trying to grab market share right now with such disruptive pricing? Seems like a tough balancing act.
It absolutely is a risk, and they didn't completely dismiss it. Management acknowledged it. They were quite clear about their, let's say, conditional preparedness.
Conditional preparedness. What does that mean?
Well, they highlighted that euro is, a highly aggressive price point. The CEO even quipped, you can't even get a small cup of tea for euro these days.
Fair play.
So their stance is basically, we're watching very closely. And if they see their market share being, quote, drastically taken, then they stated plainly, we will come to the party.
Okay, so they have the bazooka ready, but they're not firing it just yet.
Pretty much. For now, they attribute the current subdued domestic numbers primarily to the weather disruption, not necessarily the competition stealing share wholesale.
And do they have data to back up that weather recovery idea?
Yes, actually. They specifically mentioned a strong rebound right after the monsoon ended. October apparently saw immediate double-digit volume growth once the weather cleared up.
Ah, okay. That's a positive sign then.
It is. And certain key diversification segments within India are already, as they put it, firing. Their hydration category, Nimbus, grew over 50%.
50%. Wow.
And their value-added dairy segment grew roughly 100%, doubled. So there are pockets of very strong performance.
And they're also testing a new energy drink, right? Trying to bridge a price gap in that category.
That's right. Adrenaline Rush, it's positioned as a kind of mid-priced energy option, sits right between their really popular, cheaper Sting brand and the premium stuff like Red Bull.
Interesting niche. Where is it available?
Just launched recently. They're testing it in 4 cities for now, priced around 60, so very much in the early stages.
Okay, let's shift focus now. Moving away from managing the short-term heat in India to their much bigger global future plans. VBL seems to be making massive structural moves outside India, really diversifying revenue streams, reducing reliance on just one market or product type.
Absolutely. The African Foundation in particular is getting significantly stronger. South Africa, as we mentioned, is delivering powerful mid-double-digit growth. That's huge.
Double digits, yeah. That's impressive.
And the Morocco Snacks facility, that's now fully scaled up and running. Plus, Maybe most significantly, they are incorporating a brand new, wholly owned subsidiary in Kenya,
Kenya? Okay.
Varun Food and Beverages, Kenya Limited, specifically set up for local manufacturing, distribution, selling beverages there. That initial investment might seem small, but it's a clear signal of deep, long-term commitment to that market.
Definitely putting boots on the ground there. And then there's the massive pivot. VBL, the quintessential PepsiCo bottler, is actually entering the alcoholic beverage market. I mean, that is a truly fundamental shift, isn't it?
It really is. A very calculated risk, though, and they're focusing initially just on Africa.
Okay, Africa first. What's the deal?
They've secured an exclusive distribution agreement with Carlsberg Breweries AS, the big Danish brewer,
Carlsberg.
to test market the Carlsberg brand, specifically focusing on the southern African belt, places like Zambia, Zimbabwe, and the DRC.
Right. Why Africa for the beer bet specifically? Why not, say, a market with perhaps easier regulations?
It seems to boil down to two things: scale and efficiency. First, the beer market in many parts of Africa is just enormous, often rivals or even exceeds the size of the soft drink market. Huge potential volume.
Yeah, the market size is there. What's the efficiency angle?
This is where VBL's existing setup is perfect. The go-to-market structure. They can leverage the same essential infrastructure.
You mean like their trucks and warehouses?
Exactly. The same distribution trucks, the same cold chain logistics, largely the same personnel that they already use for their PepsiCo soft drinks. Management pointed out distribution won't be identical, but the overlap is huge.
So that shared infrastructure makes distributing beer incredibly cost-effective for them compared to starting from scratch.
Precisely. Initially, it's just distribution. They'll be importing the Carlsberg products. But they explicitly stated that if these test markets go well, if they feel comfortable, backward integration into actually manufacturing the beer locally will follow.
Wow. Okay. That's a big step. But that's still not all, is it? The scope of their future ambition seems almost startling. They're fundamentally altering their core corporate mandate, the Memorandum of Association,
Yes.
to allow for things far outside just beverages. Did I read that right? Noodles, vodka, frozen foods. Are they basically preparing to become some kind of general global food and beverage distributor?
Strategically, it looks that way. They are completely future-proofing their ability to expand. The MOA change is broad. It now explicitly allows them to carry on the business of ready-to-drink, RTD, alcoholic beverages.
Okay, RTDs make sense.
But also other alcoholic drinks, including wine, liquor, spirits, brandy, vodka, globally, not just Africa. And crucially, as you said, they also added non-beverage lines: frozen foods, noodles, milk powder, milk preparations. It's all officially in their mandate now.
So what does this actually mean for us, for the listener? Are we going to see, like, VBL brand noodles on supermarket shelves next month?
Haha, probably not next month. Look, this MOA change is primarily preparatory. It gives them the legal framework, ensures they don't need separate shareholder approval for every single potential new venture down the line.
Right, it removes future hurdles.
Exactly. Management did clarify they won't compete directly with PepsiCo's existing food portfolio like Lay's, but they are actively talking to PepsiCo about potentially leveraging VBL's strong distribution infrastructure to handle some of PepsiCo's own RTD products globally.
Interesting synergy there. What about alcohol in India?
That seems much further off, if ever. They mention remaining extremely cautious there due to the very strict regulatory environment and advertising limits in India for alcohol. The immediate focus for diversification seems to be international. #outro.
So wrapping this up, this quarter really demonstrated significant operational resilience, didn't it? Especially against those overwhelming weather headwinds in India.
Definitely showed resilience.
And at the same time, showcased these incredibly aggressive strategic moves for really expansive future growth, often way outside their traditional comfort zone.
That duality is unmistakable, I think. On one hand, you have this disciplined, internally focused operational efficiency, the backward integration, the careful financial management driving profit. And coupled with that, a really bold external push for long-term diversification. Think Kenya, the Carlsberg deal in Africa, and that truly sweeping MOA expansion. They're managing the present very carefully while actively building a fundamentally different, much broader future.
Okay, so final thoughts for you, the listener, to chew on. Given VBL's very conditional commitment to that competitive fun price point in India, remember, they only want to come to the party if their market share is being drastically taken.
Right, the bazooka is still holstered.
Exactly. And given that strong double-digit recovery they saw in October once the rain stopped, what do you think is the single metric, the one key indicator that will finally force their hand? What makes them decide, okay, now we fight back hard on price?
Good question. Market share drop? Or maybe a specific competitor action?
Maybe. And secondly, thinking about that expanded MOA, all those non-beverage categories, they added frozen food, noodles, milk powder. Which one of those do you think has the most natural logistical synergy with their existing African distribution network? And why might they prioritize that one first as they look beyond beverages outside India?
Yeah, which one fits best on those trucks they already have running?
That's your homework to explore.